Good afternoon and good evening, depending on your time zone. It is my pleasure to welcome you to Cornellians in our community, Spotlight on Real Estate, an event brought to you by Cornell's West Coast Alumni Affairs team. In these challenging times when there is so much uncertainty in the world, we so appreciate you being with us. My name is Lan Hee Young, and I'm a graduate from the class of 1997. It's an honor to be collaborating with the West Coast team on today's event as they serve the Cornell community by enhancing and building connections among alumni, parents, and friends from Seattle to San Diego. Our panel is so pleased to be sharing this time with you. Today we have a great panel, and it's my pleasure to introduce them to you. I'll add that we've asked all of the panelists to share what class or experience at Cornell most inspired them. Anne Bloom is from the class of 78, and along with her husband Bruce are from Seattle. Today they are joining us from Seattle, Washington. Anne grew up on a small dairy farm, so the collective experience at Cornell of meeting so many from so many backgrounds changed the path of her life. It gave her the confidence to dream big and pursue the unknown. Bruce Bloom is an ardent supporter of Cornell as a spouse and father of a Cornell tech grad. I know that he's visited the Cornell campus many times over the years and also was married at Sage Chapel in 1981. I was also married to my husband, Mark Young, at Sage Chapel in 2002, so we have that in common. Barry D Raymondo earned his MBA from the Johnson School in 1985 and joins us from the Bay Area. Bruce notes that the class he remembers most was taught by a venture capitalist out of Madison, Wisconsin. He was the first entrepreneurial chair that the business school sponsored in 1983. The entire curriculum was all about real life case studies that he had been involved in. In fact, it was the only class that he took that was so case study centric. It taught him that the words in documents such as loan docs or equity docs are merely a starting point for discussion when things don't go as planned. Dimitri Krugliac graduated in 1998 and is also in the Bay Area. While he was studying for his BA in chemistry and MEng in computer science, he took an entrepreneurship class in the Johnson School. It opened his eyes to the entrepreneurial possibilities and inspired him to apply a technical and scientific background to the world of business. Now he's bringing the engineer's thinking to the world of real estate. And while I reside full-time in LA, today I'm joining you from the Big Apple. I was most recently at Starwood Capital Group for 10 years and recently just started a new company called Sage Hall with a partner who I also went to Cornell University with. We are investing into the hopeful comeback of New York. I'm going to ask each of our panelists to share a bit about their journey to their current role. Let's start with Anne.
Hello and welcome everyone. As Len said, I graduated in 1978 and moved directly to Washington, D.C., where I was hired by the U.S. Senate to help bring the U.S. Senate online. And I worked in Senator Bob Packwood's office. And that is the first year that the Senate went online. And while I was there, I met this young man in the bottom of the Senate Russell office building. And he was finishing law school at Georgetown and working for another senator. And we moved in 1980 back to his hometown, Seattle, where he clerked for a judge and worked for a large law firm. And then in 1983, 1982, at the age of 28, came home one day and said, well, I did it. I quit and I'm going to start my own real estate company. And that was the beginning.
Yeah, so what a beginning. Well, the beginning was back in 79 when we met in the basement of the Russell building. And that was what a fortuitous and wonderful moment. It was great fun to be able to feel confident enough, I guess, to leave a solid job at the age of 28. But one of the reasons that it was easy to do is because my wife was gainfully employed by another senator back in Washington State. So that really helped out. Just a brief overview. We started just the two of us, and we were having a lot of kids. So Anne ended up being helping me out and working from home and less in the office over time. Over the decades, we've developed lots of different types of real estate, certainly including quite a bit of office, industrial, retail, and multifamily. So I think that I'd be happy to share with you our experiences, good and bad, over now probably 4 different cycles of ups and downs, almost 40 years. So it's been a fun ride, and happy to share it with you. Thanks. I think we want to hear from Barry next.
Look, my path to my career is indirect at best. I was a biochemist at Berkeley. I come from a medical family. Everyone in my family is a doctor, with the exception of me. You know, my father, my brother, my sister-in-law, my uncles, and I was supposed to be a doctor too, ergo the biochem thing. And I applied to med school. It took me a couple of years to get into med school. And in the interim, I had done research in biochemistry, and I was running a small construction company. And it sort of gave me a view of the world that, you know, there was more to the world than patients and doctors. You know, in a medical family, you're a doctor and everyone else is a patient. And I was literally on my way to med school, like packing the car, ready to go, on my way to St. Louis University. And I decided that that really was not the path that I wanted to go on. So I shifted gears. One of the guys whose houses I was remodeling said, you know what, you should go to business school. Give yourself the most optionality you can. So I figured, well, if I could get into med school, I could get into a decent business school. So I came to the East Coast, looked at all the business schools in June, fell in love with Cornell, felt like I was going to be going to school at Lake Tahoe, which was great. Although the following February, I thought I'd landed on the moon. So when I came out of Cornell, I thought I was going to do one of 2 paths, either go into real estate because I'd been doing construction for a few years, or I was going to get into medical devices, medical technologies, life science, Genentech, something like that. Sent my resumes out to anyone over 2 feet tall, and a Cornell grad it landed in her lap, who had graduated from the business school about 6 years prior to me at Lincoln Property Company. And that's really how I got into real estate, almost by default. But I run a group called Steelwave, which is a West Coast based operating company. You know, and our product is ground up and transitional life science. So, you know, it's sort of come full circle. Ground up industrial and ground up and transitional creative office. You know, our footprint is Seattle, Portland, Bay Area, LA, Orange County, San Diego, Denver, and Austin. You know, we probably developed or acquired 120 million square feet of this stuff at a cost of somewhere upwards of $13 billion. So we've been very active over really the last 30 years. So with that, I will turn it over to Dimitri.
Hi, everyone. I will make my story short and sweet. I graduated from Cornell in 1998. I got undergrad in chemistry. Then I got Master of Engineering in Computer Science because, well, computer science was very, very exciting. I came to Silicon Valley in 1998, and I have been part of Silicon Valley entrepreneurial community ever since. I've done some startups on my own, and I have been involved heavily in digital marketing. For the last 5 or so years, I guess 6, I had a digital marketing agency focused on all things, and then decided to pick one industry and go real deep. And now here I am in real estate. So I became a realtor. I went from doing marketing for agents, seeing all the issues and all the inefficiencies and all the opportunities in this industry, and then figuring out, you know what, I'm going to become part of the industry to work and reinventing it from inside. So here I am. I am right now with Keller Williams Silicon Valley. We have an office in Campbell. I'm based in San Jose. I'm covering pretty much the whole Silicon Valley, Greater Bay Area, and I'm working on some tech solutions for reinventing real estate over a certain time span.
Great, thank you. I love hearing everyone's stories about how they got into real estate. And I share a lot in common with Barry and Dimitri because I was actually in the engineering school and then moved into the hotel school. So it shows that you can come to real estate with any background, I think. So the first question I have is about the market and the stock market. GameStop and all this market activity, how has it affected commercial and residential investment trends, if at all?
Surprisingly enough, that the GameStop thing had a really significant impact on us, on Bruce and Ann Bloom and the Bloom Company. We have a AMC 10 theater in one of our properties, and it's the sort of the anchor of this retail corner near the University of Washington. And you know, they were paying zero rent for quite a long time, and which was painful to say the least for them and for us. So when GameStop came along, and then, you know, they started some of the same folks started jacking up AMC stock, it completely changed the situation financially for AMC. I mean, who would have thought? And I think they retired something like $600 million of debt and a bunch of other stuff. And truly I think that they were probably sinking fast, you know, before that, and very likely not going to stay in business or have to go through a bankruptcy reorganization at the least, to now being a fairly decent looking credit, you know, and they're paying some rent and they're going to 25%, you know, people in the theater in Seattle. So anyway, very fascinating. And I think just, you know, completely surprising outcome. So that's our experience with it.
That's great. I was so curious as to how you would answer that question. So that's really, it's amazing that the whole GameStop thing was actually a positive, amazing, helpful thing to you guys. Very cool. So the next question is for Barry. What is your opinion on SB 9 and SB 10? These are State Senators Scott Wiener's fourth attempt to radically increase the density in single-family communities across California.
You know, I got to tell you, I don't think it moves the needle much. And I think the problem is there's a monster disconnect in California between, you know, the policy rhetoric and reality. You know, the policy rhetoric is we need more housing, and more specifically, we need affordable housing. But the reality is the people who live in communities do not want more housing. And when the people that own houses in these communities, they don't view that they live in California from a housing perspective. They live in cities and local communities. And the cities and local communities are the ones that control the permitting process, the entitlements. And if you've ever taken an apartment deal through the process in California, you know that there is an enormous anti-housing coalition out there. And I just think that there's a huge disconnect between policy and reality in these communities. So I don't think it's going to move the needle much. I just don't. And when you talk about affordable housing, when you go through these processes to get entitlements for multifamily, the tap fees and the impact fees can be as much as $100,000 per unit. That doesn't lend itself to affordability here in California. So I don't think it's much of a needle mover. You know, it makes for great press, but I don't think it moves the needle at all.
Okay, that's great sad to hear for us, but makes a lot of sense. As noted in a recent New York Times article, there's been a huge exodus of people and companies from the Bay Area. Do you anticipate this being a long-term or short-term situation? It seems that places like Miami are pretty open to the tech community.
Look, I don't think you can paint California with the same migration brush. You know, Southern California and Northern California are very different. You've seen out-migration in Southern California for years. Northern California out-migration is a new phenomena, like 2020. And, you know, there's a whole lot of reasons why people are migrating out. You know, there's cost of housing, there's taxation, there's, you know, business issues vis-a-vis the government. But what's enabled people to move is functional work from home environments. And, you know, the reality is in the Bay Area, it's estimated that 50% of the jobs are enabled by work from home because of the high tech element, the business services, the financial services, whereas the rest of the nation is probably closer to 20%. And down in LA, it's probably somewhere in the 25%. So, you know, the phenomena as it relates to Northern California is very different than what's going on in Southern California. And you can't assume that everyone's just relocating to Austin or Seattle or wherever. You know, I think for the Bay Area, the #1 city is Austin, #2 is the Seattle MSA, and #3 is Sacramento. So they're not just migrating out of the state, they're actually migrating to different parts of the state too. And, you know, so I don't think you can completely generalize, but I do think that it's a longer term phenomenon than people believe.
And I would just chime in very quickly. There are also lots of people who would leave Peninsula and go somewhere to Livermore, Gilroy. They would stay within San Francisco Bay Area, but just be further from the centers of it. And that's driving the market very heavily in the outlying areas.
I mean, you've probably seen it up in Seattle, you know, the Californians coming into the MSA.
Very great point on both of you, I think. It's complicated, right? We've never been through, you know, a pandemic like this, none of us in this century anyway. So Seattle itself is you know, pretty dense urban city. We have a downtown and a bunch of urban neighborhoods surrounding that. The downtown core of Seattle had a lot of response to Black Lives Matter, to, you know, certainly have a demonstration, et cetera, and some breaking of windows, et cetera, which I think was overreported and misrepresented in a lot of cases, but it did happen. I would say that has tainted a little bit the downtown high-rise retail area temporarily. However, in the other urban neighborhoods close by, say like South Lake Union, where we're fortunate to have some buildings, and where Amazon was founded, or you know, ended up creating its headquarters, is doing really well. And then across Lake Washington, 10-15-minute drive from Seattle on a good traffic day, is Bellevue, Washington, in the MSA. To Barry's point, it's on fire, absolutely on fire. So it's, you know, it's really, like I said, difficult to generalize about Seattle, probably like it is even all of San Francisco, or certainly California. It seems very patchwork right now, and I think we're in for a fairly long ride before we feel like there's a new stability or consensus about how this all works out.
But I think like Seattle, I mean, Seattle in a lot of ways is like the Bay Area in that, take Amazon. I mean, as far as I can tell, Amazon gave Seattle proper the middle finger and said, you know what,
right,
we're going to Bellevue. And that wasn't that long ago. And they've built a 5 million square foot presence over in Bellevue. So it's not about leaving the area. It's just going to a different spot, which is somewhat like, and we're sort of seeing the migration here in San Francisco. You know, a lot of the migration is out of San Francisco proper and down the peninsula or to the East Bay. It doesn't have to be, you know, to Topeka.
I think that's happening in all the urban centers, and not just in California, but people are, there are people who I think had thought about leaving and had families, and maybe they expedited their plans a little bit. I think that's the bulk of the out migration. But you mentioned taxes. I mean, everyone always says, why do you live in California, to me? And you know, I think it's worth it, but I also think just, you know, I didn't start work and make decisions on where I lived ever based on taxes. And I would say there's plenty of people, especially the younger part of the workforce, that is definitely not making decisions based on taxes. They're not making enough money to care about the taxes in a place. So I think these cities will remain strong.
Well,
Especially
I don't think people make so much decisions based on taxes, but I do think they make decisions on cost of housing. And, you know, when you throw high taxes in there, plus the fact that California, the affordability index is 20% higher than, or 20% lower than anywhere else in the country, you know, they all add up. And so I do think the house affordability thing is probably a bigger deal, certainly at the lower income levels than the whole tax conversation. But you know, the tax conversation is not insignificant. It's got the highest corporate income taxes. It's got the highest personal income taxes. It's got the highest gas taxes. It's got the highest retail taxes. You know, go down the list, and yet it's ranked 47th in K through 12. So, you know, there's a few structural issues that are bouncing around here that I think.
Way to sell California for us, Barry. Thank you.
I would like to chime in.
Moving.
I would like to say a few words about affordability. Affordability seems like a really huge issue when you look at the sticker prices for homes. But once you start breaking it down, once you start considering your options, well, maybe you don't have to live in Palo Alto. Maybe you can live in East and South or South San Jose, or maybe you would consider a condo or townhome instead of a nice single family home with a nice backyard. And then you start looking at the financing, and then there are lots of first-time home buyer down payment assistance programs. It's actually not as unaffordable as it may seem to a lot of people who are not looking at all of those factors. But that's why there is a sentiment amongst a lot of people, oh, gee, it's unaffordable, before breaking it down. So I've been just looking at a recent survey of housing sentiment in California, and only about 28% of the population are saying that this is a good time to buy a home in California. That's a statewide survey. But on the other hand, the housing market is on fire as far as residential is concerned. So people who are staying out of the market, they're not driving the market. And people who are in the market, they understand how to manipulate the levers of the market to get what they want within reason.
And actually that kind of, we can skip to one of the other questions, Dimitri, which is, do you think it's a good time to be buying right now in San Francisco in the Bay Area?
So here's how I would answer this question always. Whether it's a good time to buy or sell should really primarily be driven by your lifestyle goals, priorities, and means. Now, if you're gonna look at what is actually happening in the market, right now we have crazy sellers market. So last year, and by the way, I'm about to share a screen and show some charts. Last year, the market went up by double digits in San Francisco Bay Area. This year, we're expecting something like this. So in the seller's market, the challenge is for buyers is you have to be a really motivated buyer to truly get something that you want. But let me just quickly show you a report. So this is a report from Altus Research for San Jose. So the most key metric that we are looking at is days on market. How long a home stays on the market on average before it's sold, right? So when you see at the end of the last year in December, it was hovering around 20, 30 through the holidays, 40, it peaked at 40s. Now it's 7 days, right? So now on average, it takes 7 days to sell a home. This is extreme seller's market. If you look at condos, we still have seller's market, but slightly less crazy. So we have 21 average days on market, right? So there are lots of other data here that we don't have time to go in depth. But basically, what I would say, we can expect the housing prices to keep rising from a perspective, is it a good time to buy? Are they going to keep rising? I would say yes. So there are other factors with financing. For example, conforming loan limits went up from last year of being 766K to 822K. So there is a lot of liquidity in the marketplace from all the stimulus that's happening, from the stock market is going up. So I would say if you have the means to buy and you feel that it's the right time for your family to buy, you have a baby on the way, or you want to have a home where you're gonna put your parents in a backyard home or whatever, you should buy. Now, if you are not quite in a position to buy, if you are concerned what's going to happen, look, these are your perceptions, right? Only you can set your perceptions, but the market is exceptionally strong. There is a lot more data, but I'm not going to bore you with it for now.
Don't forget 2% mortgage rates.
Oh yeah, absolutely. Absolutely. Yeah. Well, what I would say, the affordability, it really comes down to what your mortgage payment is going to be per month. How does it comport with how much you're making, how much you need to bring to close. And when you get into actually doing those calculations, it actually looks surprisingly affordable. And actually, let me anyways, I'm not gonna take up more time. I will revisit additional charts in further questions.
Okay, I'm going to switch gears just a little bit because we had a question from the audience. For the Bay Area and Seattle people, what's the perception of the Portland metro area for commercial real estate investment?
Well, I can speak from experience. My sense is Portland, from an office perspective, is on the rocks. You know, we bought a building up there and did a significant rework of the asset. Spent about $28 million reworking the asset, and it's in downtown Portland. And it happens to sit about a block and a half away from that courthouse that's been under siege for the last year. And my sense is that downtown Portland, there are hardly any companies that are going to say, I'm going to move a division to downtown Portland right now. I just don't see that, which means that Portland is going to have to be self-grown. And I think there's some huge headwinds in the downtown Portland. Now, there's always, you know, if you're in the Pearl District, you know, which is super cool, maybe it's a little bit different. But if you're in the financial part of downtown Portland, I think there's some real headwinds. I don't know, Bruce and Ann, I don't know, do you own anything in Portland?
In a way, unfortunately not, just because I think, to your point, the pricing, you know, opportunity now there might be pretty good if you're looking at a 15, 20 year span, because of the issues you mentioned. Tend to think that, you know, people's sense of public safety, et cetera, will improve over time. You know, who knows? But I think it might be a fairly prudent time to invest long term there.
Yeah, I think long term it'll be fine. You know,
Yeah.
I just think over the next 2 years, I just think what was driving the Portland story was in-migration relative to companies moving divisions there. They weren't moving sort of headquarters, but they were moving divisions to Portland. And I think people have just put the brakes on that. You know, over time, I think it'll happen again, just because quality of life and everything is pretty good in Portland.
So this is a question for Barry and whoever else wants to chime in, but just given what you're working on, which is, I would call it the flavor for everybody that they're looking for is life sciences real estate. How have you seen office evolve over the years?
Well, look, I think prior to 2000, the office work environment had been stagnant for 4 decades. I mean, completely stagnant. And, you know, it was a byproduct of, you know, how companies thought about best practices, how they thought about organizational structure, but it was a much more siloed environment. And, you know, you had execs sitting in big private offices on the glass line with the secretaries in the bullpens. And I think it started really in the late 90s. And by 2010, the rate of change was hyper accelerated. And it was mostly led by the tech sector. And basically, the model for running a business changed. It became much more team oriented, much more collaborative. And the physical space had to change with it. And interestingly enough, I think in the Bay Area, the leader of this was a group called Silicon Graphics, and they built a headquarters building in Mountain View that when they built it, the whole real estate community was scratching their head because it was this huge student union. It wasn't an office building, it was a student union. And the whole idea is that they wanted to attract talent from Stanford. They wanted them to think like they were still at Stanford. And in 2000, we, along with Goldman Sachs, bought their headquarters along with 4 other buildings that they were either developing or they had land to develop. And the idea was that they would do a lease back, and over time they'd burn out of it. And we bought it at the absolute peak of the market. When rents were $6 net per square foot for about 42 minutes. And right after we bought it, the market crashed and went to like $1.50 net. And they were having problems. They needed to contract a little bit faster. And we basically said, okay, you can do whatever you want and we'll let you contract out of the normal buildings, but you can't contract out of that headquarters building because we don't know what to do with it, right? So along comes this company called Google. They hadn't gone public yet. I didn't even know what a search engine was. We actually turned them down for a lease. They didn't want anything to do with the standard buildings. All they wanted was the student union building. And we turned them down. And then 4 months later, after we had talked to exactly 0 prospects, we ended up signing a lease with them for 15 years. And, now it's their world headquarters and has been, and so we had actually written the project down by $50 million, and they had an option to buy the damn thing at a ridiculous price that no one would have actually triggered that price because they had a 15-year flat lease rate. They ended up triggering that thing, and what was a complete disaster turned into something pretty interesting. But that's what they wanted. They wanted that work environment. They didn't want anything to do with the standard buildings. They wanted this student union environment. We gave them $5 of TIs, and they spent 100% of that on the bathrooms, putting in the Japanese toilets. Those fancy Japanese toilets.
Love those.
That's all they did, okay? And they took everything lock, stock, and barrel elsewise because it was perfect. But yeah, I think they figured out, I think the tech world figured out that if you made the office work environment seem like it wasn't the office work environment, you'd have people that wanted to hang out there, spend more hours there, and get more done. And so, today I would say it's more of a resort environment than the 1960s office environment.
I think we can just talk a little bit just about, we're in a pandemic. What do you all see? And we can start with Anne and Bruce, just on what's going to happen when we come out of this pandemic in terms of real estate.
She's making me do the talking. So, from a real estate point of view, in coming out of the pandemic, I think we're already seeing some flight from traditional tech centers to, from all the way from Seattle to Bellevue or from San Francisco to Austin, et cetera. My guess, and it's a guess, is that over the next year plus, people will, we will be at, a healthier country and a healthier world. We will resume more travel, more social activities, gatherings, going to the movies, hanging out together, being in an office with other people. And my sense is that people are very social, and they are looking forward to that sort of normalcy again. In the broader trend, at least again, of how the pandemic has impacted stay-home work versus being in the office, what we're starting to see in Seattle now in the buildings that we own and operate, a number of which are office buildings, and with high-tech companies like Amazon and Facebook, people are coming back. I noticed today there's an article in our paper that 10% of Facebook offices in Seattle and Bellevue will be occupied, like starting now. Can imagine after the end of May, if most of the populace, or who want to at least, have received the vaccine, that come June, July, August, September, I would expect that in the buildings that we own and operate, we'll be seeing 50, 60, 70% of people coming back. Not necessarily every day of the week. I think a lot of these employers are providing flexible hours and opportunities, which from an urban density traffic point of view could be a real bonus, to not have everybody doing the 9 to 5 commute. So I think there might be some good things that come out of this in terms of, I would not want to be a speculative office builder now at all in any of these markets. Well, I'm sure there are some markets, the markets that I'm in, at least, or we're in. I think if I were Barry and had the access to the money, I'd be building some spec biotech buildings in Seattle, because I think you can fill those.
Maybe you can help Barry do that.
Yeah,
We're actually doing
maybe.
a lot of life science.
I've got a couple sites that I don't know what to do with. But biotech is it's such a strange thing. And one more point I wanted to make, or observation, is how unpredictable everything is, in life and real estate, et cetera. And Barry's story was great about Google. Similar story for us. We had two buildings in South Lake Union, that one of which we built in the early 90s, and the other one in about 2000. They're a couple 100,000 square feet, each about 100,000 feet. And at some point, and I can't remember exactly when, we had a multi-tenanted, I got a call from a broker and said, the Gates Foundation, which was nearby, said they just bought this huge piece of property near the Space Needle, and they're going to build this giant world headquarters. And they need a place to be for the next, at least 5 to 7 years. Do you think maybe you could, when your leases come up in those buildings, take care of them? And sure enough, just like Barry's story, they were fine. They were doing okay, but ups and downs and vacancies. And, all of a sudden, we just got lucky. We were so fortunate to have those leases, and for really quite a long period of time. So I guess part of this thing is just taking some risk and putting yourself in a position to be in the path of progress and hang on for the ride.
How about Dimitri?
Yeah, look, I think
your thoughts too.
You can't paint all of real estate with the same COVID brush, right? For industrial, it's been a complete windfall, with e-commerce, so
Still data centers.
Industrial, you're pretty happy over the last 12 months.
Exactly.
Life science is sort of the same thing, right? Office or retail, maybe less so. Multifamily is pretty good, I think, still. It's differentiated based on experience. But I agree. I don't think office is a thing of the past by any stretch of the imagination. I think, this whole COVID thing accelerated some trends that you were already starting to see. I think certainly for the tech users, that they don't want standard buildings. They want cool and vibrant, neighborhoods, and they want, buildings that probably are less dense, a little bit more low-risey type stuff. So look, I think what it's done is accelerated trends that were already starting to move. But I don't think office is a thing of the past. I think commodity office in commodity locations here in the Bay Area are going to have some headwinds for a couple of years. That doesn't mean that, it's a disaster. It just means that, they're going to have some leasing headwinds.
So if I would add my perspective on office, I don't deal with office directly much. Sometimes it comes up, but mostly I see office through the viewpoint of residential. And what I see, people still want to be able to come to the office. Companies still want to be able to look employees in the eye and figure out whether they're actually doing their job or you know, or slacking off. But because now we have social distancing, people train themselves, condition themselves to see each other face to face less, so people can live further away and get a nicer home at a larger distance and maybe come to the office a few days a week rather than every day. So I think something like this could become a permanent trend, but is it going to happen? It's really hard to predict what's happening with all the changes with the pandemic. So I think we're going to get back to some kind of normal. We're going to have more virtual interaction. There's still going to be some actual face-to-face interaction in the office, but a lot more people are just going to spread out further through the metro areas and just not come to office as often. And what's going to mean, it's going to mean the boom in all those exurbs. However you define them, we are seeing this already. Certain communities went up last year. There is a certain community in the East Bay, Mountain House. It's San Joaquin County, so technically it's not Silicon Valley, but it's right on the border with Alameda County. It's a planned community built in the middle of nowhere. Just there is a freeway there. So the home prices there went in a few months last year after the pandemic. After the initial lockdowns ended, the prices ran up from 600s to 800s, right? Just in a few months. So this is probably an extreme example, but we're seeing across the boards exurbs are booming because there is expectation that everybody's not going to have to come to the office every day.
I have to say that I think the social distancing aspect of offices, I don't know if that's going to just come back after everyone's vaccinated, because there'll be a season. I don't think it's means that it's gone forever. And so I think that spacing will just be I toured an office building that we're looking at yesterday, and completely empty, the entire building. And you know, there was 1,000 square feet of space, I'd say, in the middle with 50 seats, and it scared me, you know. And it was, I just think about anyone else coming back, they're not going to want to see that. And I think it's going to take a long time to ever see that again, if we do. And I do think people are spacing out. And I don't see that changing.
I think it might change once the social distance, once all the public health measures are lifted, right? Because a lot of people are following all those social distancing guidelines because there are health directives. At some point, those health directives are going to go away. I think you might see a strong reversal. When we look at the last major pandemic, Spanish flu, right? It started in 1918. It ended in 1920, so 2 years. We are in a year or two. We're just starting a year or two. And what we had after the Spanish flu, we had the roaring 20s, right? So so I would not rule out that we're gonna have stuff like this happening again. But you know what? Nobody has a crystal ball to be certain. We can prognosticate.
I agree with you so much on the leisure side. That's where we think that's going to come roaring back, because there's pent up kind of travel demands. The thing is that after people get that out of the way, there may be another drop. And then, you know, so that's the way that we're looking at the leisure market. For example, in New York City, people are excited to go to Broadway shows. They might do that, but it doesn't mean that it's a sustained kind of thing for forever. So also we're seeing a flight to quality and a lot of upgrading. So, you know, people using the opportunity in these cities that have become all of a sudden overnight more affordable, 20 to 30% off, and saying, you know what, I'm going to live in the neighborhood I want to live in, or in a bigger apartment. Or so you're seeing a lot of that happen. And these cities are, I can't remember who said it, that this, I think Bruce, you said that the cities are going to be more livable and possibly better. I think that that's actually could happen, where things are getting more affordable. Could be less traffic, not everybody going in at the same time. Outdoor dining everywhere. In places, I live in Los Angeles, we really didn't have a lot of outdoor dining. It never made any sense. Now it's everywhere. So, you know, I think there are some positives that we can take away from this. So let's see if we have any questions from the audience. Someone is asking about our insights on commercial and residential outlook for Greater Sacramento. Does anyone have an answer?
I can say a few words. Lots of people in Bay Area, they're buying a property in Sacramento. They keep buying it. So Sacramento market is heavily driven by out of town investors. There are lots of people living in Bay Area going in Sacramento. So there is not enough inventory anywhere. So I would almost look like at Sacramento as part of Greater Bay Area, very, very greater, because it's just a 2-hour drive, right? So I see this all the time. Somebody is retired, time to go somewhere, and they're thinking, are we gonna move to? There are people who are gonna move to Idaho, right? So who might want a completely different climate, right? But there are people who want to stay in California. If they want to be within a driving distance of where they used to be before, Sacramento and less so Stockton is one of those destinations. If somebody wants more sunshine, they might end up moving to San Diego. So I would also note there is something really big that passed last year, Proposition 19 in California. So this means anybody over the age of 55 or disabled or fire victim whose home burned down, they can move anywhere within the state of California and keep their low tax assessment. And the way property taxes work in California, somebody could be living in their home for, I don't know, 30 or whatever years. They're paying extremely low taxes. Without this proposition, they would move somewhere, they would pay taxes at the market value of their new home. Now, those type of migrations are going to be more facilitated. But as Barry said earlier about high density development, this is supposed to generate some inventory, but nowhere near to satisfy the demand, because the demand is just insane. So anyway, Sacramento, it's a very hot market as well.
I think
have a
from a
really-
commercial perspective, rents don't move in Sacramento, and they haven't moved for years. That's just the reality of it. You know, my experience with Sacramento is that if you don't get in at the absolute bottom of a trough, it's tough sledding. That's number one. Number two, I don't think the institutional investor embraces Sacramento. I mean, there's a lot of institutions who just say, forget it. We're just not doing Sacramento. So, you know, for us, you know, we've been in and out of Sacramento. It's not at the top of my list by any stretch of the imagination. But you got a lot of people moving there. And I think a lot of people who are moving there are actually still working in the Bay Area in some way, shape, or form.
Yeah, I worked at 2 firms that invested, you know, private equity investors investing into Sacramento. And one was, you know, during the financial crisis, it was like a broken development, the largest one on the water. And they took over, and I don't even know what actually ended up happening. But as you said, I think they'll be fine. And then my previous company, we bought an office tower and we got out, you know, but not at our targeted returns. So we did well, like fine, but it's not a very liquid market, as you said, Barry, in terms of institutions. So, I mean, even New York right now is not as liquid. It was the most liquid real estate market in the world at one point. It's not right now. So, you know, on a relative basis to say New York or San Francisco or then Seattle, it's a different dynamic.
I agree.
Well, I'd like to follow up on something Barry said. Barry mentioned if you're buying in Sacramento, you want to find a deal. But I would say that wherever you are buying, you should still look for a deal, right? So in every transaction, you can see that somebody has higher or lower advantage. Either buyers getting a deal or sellers getting a deal. So wherever you are buying, whenever you are buying, whichever market you are in, there are still properties that sell at so-called market. There are properties that sell below market. There are properties that sell above market. So if you are a buyer, you always want to find properties which are under marketed, potential of market, find seller motivation to get rid of it without creating the most competitive situation. If you are the seller, you want to create the most competitive situation you can to aggregate all the market demand to get the highest possible price. At the extreme example, you can do this something with something like an auction. And I'm working, for example, with an auction company that originated in Australia. They brought their model into US, and it's pretty crazy to see how much those properties sell for compared to what so-called market value is, because there is always that buyer who really falls in love. They really have to get the property. They bid against other buyers, they get it. But if you're a savvy buyer that wants to get a deal, you want to be looking off market. You want to be reaching out to sellers, finding that motivation to sell right now at whatever cost.
Great advice. So we have a question. What would you say to a young person just starting out in real estate? Words of advice about taking risks, seizing opportunities. I love this question. Who wants to take this first? Maybe
well,
Anne, because we
Anne, Anne's turn. No, Anne's turn.
No,
Yes.
no. You know, for us, we did have, you know, when we started and Bruce was so young, he worked as a real estate attorney in a large firm. So he had some experience in connections, and that's really important. And he did start out with industrial first.
Industrial and small office.
And small office.
And a small retail. I mean, all kind of commercial real estate. Yeah.
And then
Yeah. So you know, things have really changed a lot in terms of how people approach developing real estate. And back in that time, in the early mid 80s and on, it seemed like there were a number of, you know, entrepreneurial smaller businesses who did real estate development. And you know, even though for a period of maybe 20 years in Seattle, you would sort of know who was in the game and who did it. And, you know, it was a mid-sized growing city. Maybe 20 or 30 development companies, even fewer, that were in the paper all the time, and you knew who they were. This was all pre the internationalization and financialization of real estate, before REITs, you know, but before having everybody in the world, you know, investing in different properties. So back then it actually made some sense, I guess, to start something small and grow it and actually find yourself in a position to own some of it. What we did initially is syndicated, created, you know, limited partnerships, now LLCs, and, you know, found people to invest in our projects essentially. And we got to the point where we would refinance those or sell them, and then have a greater share in our newer projects, and continue to get to the point where we were either the majority owners or sole owners of our buildings, so that we create a portfolio. I think you can do that again today, but you know, the risks are obviously you're sometimes if you're trying to go very large, you're competing against capital stacks that, you know, basically are just going to beat you every time. And in terms of the availability of liquidity and the cost of money, you know, it's really tough, I think. So at the larger scale. So I think my advice would be is, if you want to be an entrepreneur and own your own properties, think small, and maybe think small and think in terms of more deals, you know, whether that's small industrial or, you know, multifamily, et cetera. You know, we've looked at this in our office, and generationally, that, you know, we've done some small industrial properties over in Idaho, and they might be $3 million or something like that. And those are performing extremely well. And you don't have to have a ton of capital to do that. And you're not competing with, you know, with Wall Street and the REITs. So that's my 2 cents.
I tend to agree. Look, real estate's got a million different fingers. I mean, you can get into real estate through the private equity side of it. You can get into real estate through the debt side of it. You can get into real estate through the entrepreneurial development side of it. You can get into real estate from the brokerage side of it. So, you know, it's one of these things that's got a million different silos. And you can actually jump from silo to silo throughout your career. Now you can get on the brokerage side of it, move into the development side of it, and vice versa, and all that stuff. So, and you can go work for a big company, you go work for a little dinky company. So, there's a lot of different pieces of the real estate market. One of the things I think schools do a really lousy job of is giving kids who have an interest in real estate a sense of the big picture. I mean, I've taught this class before, and it's basically, it's a class about where the money starts from on the far left side and how it ends up getting through the pointy end of the sword on the far right side, whether it's, getting invested into, very small entrepreneurial deals or big deals. It sort of starts on the pension fund side, moves through private equity firms, and sort of how it marches down this capital supply chain. And when you realize how many different real estate avenues there are, and it's not just real estate, it could be venture capital, you could come up with the same sword, if you will. There's a million different pieces of the food chain that you can occupy. And depending on where you are in that food chain, it is a wildly different cultural experience. If you're working for the state of California on the pension fund side versus working for, someone on the, entrepreneurial development side, those are just wildly different ecosystems. So you sort of have to figure out what you like, what you're looking for, and then find the sleeve that fits it.
Yeah, and I would say if you want to go into real estate, whichever of the subsegments you go into, you gotta get a sense that this is something that you want to do, and you have something to offer that's going to be differentiated. I can speak from my experience getting into real estate relatively recently. I came from tech, I came from marketing, so I saw my opportunity right away as reimagining the residential real estate sales process, seeing all the inefficiencies, seeing how much automation can be brought to the process, all the data. So from my perspective, I look at the opportunity to build a better process for buying and selling homes, and I'm starting on residential side and then getting my hands dirty actually doing this. And at some point, this is going to turn into processes, systems, software, scaling, and there are multiple models for that. I don't have all the answers yet how that's going to happen. But in any case, whichever your interest in real estate is, just make sure you are bringing something to the table that's going to be differentiated in some way.
But I agree with Bruce. If I was going to get into it, I'd get into small industrial and just build a portfolio. It's simple, it's not complex, and and over time, if you can just build, and if you can do it on your balance sheet and just build a big portfolio over time, you'll be a happy individual.
I have to say that there are so many elements of what you have all said that I agree with. I think real estate is such a diverse environment. You can kind of pursue anything. And I think we're such a diverse panel of people. I've never been on a panel like this where there are so many different property type owners, and I'm coming from the private equity side, and then we have a residential brokerage side. That I've never seen anything like this. So I think it's kind of cool that we could do this through Cornell. It's so rare to see, and that I think it just shows what real estate is about. Another thing that I think, Anne said earlier about just having knowledge and experience to some extent beforehand, or getting trained, whether it's on the legal side or the financial side of real estate, or even the architectural or the building or the construction side. All of that is so important, I think, as a background or backdrop to pursuing a longer term career. I think learning all the time is so important. And then taking risks, because that was part of the question. I think always take risk if you feel like you can. And even if you feel like you can't, I think taking risk, especially in these kind of times, we're in a pandemic, the vacancy in terms of usage of so many of these buildings is very low. It's just like things are going to get turned upside down. It's a great time to get into this space when no one knows what's going to happen, because you can carve out your own space. So I would just say every time I've taken risk and I've moved jobs in the middle of the financial crisis last time, and people thought I was crazy. I had a really good job at another private equity firm, but I moved in 2010, and it was the best thing I ever did, because from 2010 to 20, it went straight up. Everything went straight up. So that would be my advice. I don't really have anything else to ask. I don't know if any of the panelists have any questions that they want to ask each other.
What I
We
can
can also
tell
keep
people-
going and take some more questions.
Go ahead.
Okay. This is a follow-on with Sacramento. If not Sacramento, what is at the top of your list, Barry?
Well, we're doing a lot of life science here in Northern California. And, you know, I would say at the top of my list right now is life science in 100% locations in Northern California. We got into the life science business when it was super risky, and this was back in the late 80s. And we sort of leaped in the late 80s and limped out in the early 90s because, you know, back in the late 80s, none of the users were making any money. And the interiors were all specialized, and, you know, what worked for one guy didn't work for the next guy. And it was not a good time to be in the space. And then we got back in 2012 when we realized that the users had products and they were making money, and all of that complex lab benching had become modular. And you just wheel it in, you plug it in, you can move it around, you can do all that stuff. And then what we saw happening in 2017 really was a structural shift in the whole industry. You know, we saw life science merging with data science, you know, AI, machine learning, and all that stuff. And, you know, what's that's done is completely changed the risk profile of investing in, you know, early stage, you know, gene therapy companies and early stage drug discovery stuff. You know, it's taken what's a 7 to 10 year process and shrunk it to something that's probably closer to 3 to 5 years. The cost has gone way down. The hit rates have gone way up. And that's why you've seen this tsunami of capital flood into the space. You know, a lot of people say, well, it's all COVID related. No, it was happening before the whole COVID thing. And if you track the employment graphs and you look at capital investment in the space versus employment obviously drives real estate. They're two mirror graphs. They just happen to be separated by about 30 months. You know, so when you see the capital come in, 30 months later, it's got the employment impacts. And we don't see that capital flattening out anytime soon. We see it actually, you know, growing. So, you know, we sort of look for a location, whether it's life science or creative office, we're looking for locations that people want to be. You know, we're not basis buyers. You know, we're not looking to buy on the cheap. We're buying it so cheap, how can we lose? No, we're not doing that at all. We're looking for 100% locations, and we're almost ambivalent to cost. You know, because we think at the end of the day, if you've got a long-term view on it, and 100% location is going to be 100% location forever, right? I mean, if we could do a bunch of stuff in downtown Palo Alto, we would buy everything we could buy in downtown Palo Alto. Unfortunately, it's hard to do. So look, location is everything. And I would be ambivalent to cost and pay up for the right locations. And every deal we've ever done where it was a basis bet and we thought we were buying it so cheap we couldn't lose money. I mean, if you look at, because we've actually taken the portfolio over time and done all sorts of studies. The basis bets versus the ones where we almost couldn't swallow the cost because it was too high, but we knew it was a good location. There's at least 400 basis points difference in average yields. As in, the more expensive stuff ended up being 400 basis points higher in yield than the cheap stuff. So that would be my advice.
Also in the range of returns, I think you're just tightening it, because I think right now there's an opportunity to invest in real estate where you can kind of cap your downside, but also, as you said, you could actually get lucky and do even better. And that's very rare, to be able to protect your downside and have a ton of upside. You don't get that very often. So,
Well, that's what concerns me about, industrial right now. I've always had the philosophy that low cap rates make for tall cliffs. And the industrial cap rates right now are so low. If there's any kind of spring up at all, it becomes super painful to the equity. Having said that, we're doing a whole bunch of it, so we'll see where it goes.
I love that we may have gotten some deals done on this.
Yeah, you never know.
I think that would be a great follow-up discussion if something ever ends up happening. Thank you all for attending tonight, and we hope to see you next time in person.